Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of demystifying goodwill in mergers and acquisitions. Transparency in financial reporting. Investors and analysts rely on detailed financial statements to gauge long-term performance. Clear separation of goodwill and intangible assets ensures transparency, helping stakeholders make informed decisions. For instance, knowing that a large portion of goodwill stems from customer loyalty rather than tangible brand investments highlights different levels of risk. Strategic planning. Differentiating intangible assets also aids in strategic business planning. For example, while goodwill might capture a company's overall positive image in the market, intangible assets like patents or trademarks represent specific opportunities for growth, licensing, or market expansion. Think of goodwill as the overall personality of a business, while intangible assets are its skills and talents. Both matter, but understanding their differences helps paint a clear financial picture. And for stakeholders, clarity is everything. Calculating goodwill. Understanding how to calculate goodwill is essential when discussing business acquisitions. Goodwill represents the premium buyers are willing to pay above the actual worth of tangible and identifiable intangible assets. It's tied to factors like brand loyalty, customer relationships, and reputation, qualities that aren't easily quantified but hold significant value in a company's success. Formula for goodwill calculation. At its core, calculating goodwill is fairly straightforward. It involves subtracting the fair market value of net assets from the purchase price paid for the company. Here's the formula. Goodwill equals purchase price, fair market value of assets liabilities. Let's break this down with an example. Imagine Company A purchases Company B for $10 million. Company B has the following: total assets worth $7 million. Liabilities totaling $2 million. To calculate goodwill, subtract liabilities from assets to determine the net assets. $7 million. Assets, $2 million. Liabilities, equals $5 million. Subtract the net assets from the purchase price. $10 million. Purchase price, $5 million. Net assets, equals $5 million. In this scenario, Company A records $5 million as goodwill on its balance sheet. This value reflects the business's intangibles, its reputation, customer base, and other unrecorded advantages. Factors influencing goodwill valuation. Goodwill isn't a static number. Various factors can either inflate or reduce its value during negotiations or audits. Let's explore a few key elements that shape goodwill valuation. Market conditions. The economy and industry trends heavily impact goodwill. For instance, a thriving market may lead to higher goodwill as businesses are more competitive and willing to pay a premium. Conversely, during economic downturns, buyers may hesitate to pay extra, reducing goodwill valuations. Reputation and brand value. Customers are often willing to pay more for trusted brands. A company with excellent reviews, high employee retention, and a loyal following carries substantial goodwill. If public perception drops due to scandals or poor service, goodwill takes a hit. Competitive advantage. Think of a business with unique processes, exclusive supplier agreements, or strong intellectual property. These elements amplify goodwill since they're difficult to replicate. The stronger the competitive advantage, the higher the perceived goodwill. Customer relationships. A business with recurring contracts, loyal clients, or strong customer retention rates will undeniably increase its goodwill value. Buyers are willing to pay more for companies with proven, long-term customer loyalty. Location. Ever notice how some businesses thrive simply due to their address? A prime location, like a coffee shop on a bustling corner or a store in a prestigious mall, can significantly boost goodwill. Management and employee expertise. Strong leadership and skilled employees add immeasurable value to a company. Buyers see this as a competitive edge and may reflect it in the goodwill calculation. Goodwill valuation is not merely math, it's a blend of numbers and nuanced factors. Buyers use it to evaluate how much a company is worth beyond its tangible net assets. From market shifts to customer trust, Goodwill paints a more complete picture of what a business truly offers. Accounting for intangible assets. Intangible assets and goodwill are essential components of financial reporting, but how they're treated depends on several factors. From differing accounting standards to specific rules for measuring value or recognizing losses, knowing the details is crucial for accurate reporting. Let's explore the complexities of accounting for intangible assets. GAAP versus IFRS. Compare how US GAAP and IFRS treat intangible assets and goodwill. Accounting for intangible assets and goodwill varies significantly between US GAAP, generally accepted accounting principles, and IFRS, International Financial Reporting Standards. While both aim to provide clarity and consistency, they approach recognition, measurement, and treatment differently. Here are the key contrasts. Recognition of intangible assets. Under GAAP, intangible assets are only recognized if they are identifiable, meaning they arise from contractual or legal rights or can be separated from the business and sold. IFRS, on the other hand, uses a broader recognition criterion. Intangible assets need to be likely to result in future economic benefits and measurable at a cost that's reliably determinable. In practice, this means IFRS may recognize more intangible assets compared to GAAP. Goodwill recognition. Both GAAP and IFRS treat goodwill as an asset that only arises during acquisitions. However, goodwill is never amortized under either standard. Instead, it is subject to impairment testing. Impairment testing for goodwill. Under GAAP, impairment testing must be done annually, or whenever there is a triggering event that hints at possible impairment. It uses a two-step model to determine the loss. Conversely, IFRS requires goodwill impairment testing annually but simplifies the process with a one-step model that compares the carrying amount to the recoverable amount. This difference can make IFRS testing less cumbersome for businesses. Revaluation of intangible assets. IFRS provides the option to revalue intangible assets to reflect fair market value, provided an active market exists for those assets, e.g., trademarks or patents. GAAP does not allow revaluation. Intangible assets are carried at their historical cost, minus amortization or impairment. In short, IFRS is more flexible, often allowing broader recognition and revaluation options, whereas GAAP focuses on strict definitions and cost-based valuation. These differences can lead to significant variations in reported financial outcomes depending on the standard applied. Amortization and impairment. Explain how intangible assets are amortized and how impairment losses are recognized. When it comes to intangible assets, companies must account for their use over time or address any loss in value. This happens through amortization and impairment. Here's how it works. Amortization. Intangible assets with a finite lifespan, like patents, software, or licensing agreements, are amortized. Amortization is the process of systematically spreading the cost of the asset over its useful life. Think of it as paying off the value of an asset bit by bit, similar to depreciation for tangible assets. For example, if a company has a patent worth $100,000 with a 10-year lifespan, it would record $10,000 annually as an amortization expense. This reduces the book value of the asset over time while accounting for the expense in income statements. Intangible assets with indefinite lifespans, such as goodwill or some trademarks, are not amortized. They remain on the balance sheet at their original recorded value until tested for impairment. Impairment losses. Impairment happens when the carrying amount of an intangible asset exceeds its recoverable value. Simply put, it occurs when an asset loses its ability to generate the economic benefits originally expected. When this happens, the asset's value must be written down, and the impairment loss is recognized on the income statement. Under GAAP, impairment tests are event-driven. For goodwill, this means testing when there's a trigger, like declining market conditions or poor financial performance, or conducting annual reviews. The two-step process first assesses whether the asset's value has likely dropped. If yes, the exact impairment amount is calculated and recorded. Under IFRS, impairment testing uses a one-step process. The asset's carrying value is directly compared to its recoverable amount, whichever is higher. Fair value less costs to sell or value in use. Any excess is written off immediately as an impairment loss. Let's tie this into an example to make it relatable. Imagine a company owns a valuable customer list classified as an intangible asset. If a competitor renders the list obsolete due to better offerings or a legal change makes its use challenging, the list would fail the impairment test. The company would reduce the carrying value to reflect its diminished usefulness, with the difference recorded as an expense. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.